Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax-free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy.
So just as a reminder, you are muted. There is Q&A available. You hit that Q&A button at the bottom of your screen. Chat should be disabled, and of course you are being recorded. So as I said, we're running through these classes. We've got a lot coming up today in planning. We're going to talk about year-end planning, capital gains. Last week we talked about for year-end planning Roth conversions. I believe a week or two before that it was income. So I do have an update. So you should have received if you're a client already, you should have received notification of this, but we received notification from one of our investment companies that they need to have their Roth conversion paperwork in good order in-house by November 19th. Now, I always caution folks of this. If you're doing this on your own, make sure that your custodian, you know the custodian date. So our custodian currently is Fidelity, National Financial Services, which is Fidelity. And in the past, they've given us till about second or it's a third week in December. But this year, they said, I think we have the 26th or somewhere around the 26th of November for them and the 19th for the other. So our schedule just became really truncated for Roth conversions. And it's a bit of there's a lot of pressure, right? Because we plan this all year long, and we start these conversion conversations if you have to wait until the end of the year in September, but just to have everything done by mid-November, as you can imagine, a month earlier, put some stress, but we're ready. We have everything prepared. The majority of you who we reach out to have already scheduled appointments, which is great. What we did was we blocked out a couple of weeks just for you folks. If you can't find something on the calendar, reach out to us so we can get you in. This is vitally important that we get this done. All right. So one of the things I want to talk about in headlines is, you hear me talk about our team, the team that you want to put together to help manage your retirement, your investments, this side of your life. And obviously, I believe a qualified certified financial planner should be part of that. And I'm going to talk again about the benefits of this Slott training and the fact that I'm still amazed that there's a little over 400 of us. I think it's 420 some in the country, but it's not enough. This material is so important and so good. I am always just so excited coming out of these training classes because I just feel like I get better and better and more educated about it every year. And listen, that's what I want. I want to be the very best at what we do for you. So one of those team members should be a CPA. And of course, the other should be at least one attorney. Everyone should have at least an estate attorney. Often that estate attorney can also be an elder law attorney. So if you don't consider yourself elderly, then you may have parents who may need that kind of help. But listen, if you're in your mid 60s or early 60s, it's probably good to start having that conversation with an elder law attorney because you develop that relationship throughout your life. And that person will be there when you need him or her. And also the proper planning will be done. But let me go back to the CPA for a second, because as we're going through this year-end tax plan, I just want to share with you a couple of CPA mistakes. This doesn't mean that these folks are bad at what they do. It's just, again, specialized. The work that we do is very, very specialized. And it's important that people understand exactly what we're trying to achieve and the rules and regulations and laws and allowances and disallowances behind those things. So the first thing is, and these both happen to be female CPAs. I'm not picking on that, but when I say her, that's just the situation. So I guess I don't even have to use that pronoun. So this CPA, one contacted me, or a client contacted me and said, oh my gosh, we did an over conversion, my CPA says, and I have to take the money out and now correct it because we converted too much. And I said, well, I'm speaking to the client. Are you talking about conversion or are you talking about contribution? And she said, no, conversion. So we did this is what happened. So I understood immediately what happened. The CPA was mistaking contribution for conversion. So my first question to the CPA, we did a conference call, was, are you talking about a conversion or are you talking about a contribution? She was, it seemed like she was reading something to me that read, you can only contribute X number of dollars, $7,000 in this case for this person, and or you can only convert. She used the word conversion, $7,000 in this case, and you convert it, whatever it was, $30,000. Was she? I immediately knew that she had it wrong. This person had it wrong. So this person, I said to this person, well, I think you're confusing conversions with contributions. Contribution levels are at $7,000 a year. Conversions, you can convert as much as you like, and there is no remedy if you overconvert. If you overconvert because you're paying more tax than you wanted to, or it's affecting your Medicare payments or something like that, that's a different story. That may be considered an overconversion in your mind, but it doesn't exist from an IRS regulation point of view right now. There also is no mechanism for fixing that. There is no recharacterization of a Roth conversion anymore. There is for a contribution. So we can recharacterize a contribution until October 15th of the year following the year you do the contribution. But we're simply talking about conversion. And this CPA was completely confused of the difference between a contribution and a conversion as it applied to this case. I'm certain she knew the difference between a contribution and a conversion, but she was combining the two. So that's just one example. So these are fresh and these happened recently. That's why I bring it up too. The second one is we received notification from a CPA that their client could not do a contribution because their income was too high due to conversions. So that's confusing, I know, but let's put it as an example. You can contribute to a Roth IRA if you have earned income and you are below certain income thresholds. So if you'd like to find those income thresholds, I'll actually pull this up on my website for you again. I should have had this ready, so bear with me here. I'm going to share my screen. And I know I do this a lot, but I think it's good practice for you if you need to find something quickly. These resources that I always point to are in the Slott corner. So that is the Ed Slott corner. And I put it in there because this is Ed's material and I want to give him the credit for it. So we're going to talk about this tax planning chart in a second, but I'm referring to this plan contribution. So you'll see here the IRA and Roth IRA contribution limits were in 2021 are the same. If you're under 50 years old, you can contribute up to $6,000 a year. If you're over 50, you can contribute up to $7,000 a year. So that we're talking about Roth IRAs in this case, and you can see there are phase out levels. So in 2021, if you're married filing jointly and you make above in modified adjusted gross income $198,000 to $208,000 a year, the contribution level is reduced that you can contribute to a Roth IRA until it hits zero. And if you're single, it's 125 to 140,000 with this exception. So this CPA had said the income, the regular income that this person has, the earned income is below the threshold here, a married couple, of the 198,208. That's fine. Let's say it was $150,000. That's fine. So with that, we have earned income. We have an amount that's below the income phase out thresholds. And he says, but once you did that conversion for $200,000, it added to the $150,000, and now we're too much, right? We can't do it because of the phase outs. Well, the issue is that there is an exclusion for Roth conversions as it applies to contributions in the tax law, and the tax law says that any conversions don't count to modified adjusted gross income, just for the case of Roth contributions. They of course count towards modified adjusted gross income for tax credits and IRMA calculations, income related monthly adjustment amounts that affects your Medicare. So I understand that's very nuanced, and these are very good professionals. My point is they didn't understand these nuances because they don't specialize in this area. So it's a good opportunity for education for me. It's a good opportunity to kind of spread the word a little bit out there. You know, I've shared with you that 2 years ago, I had a client CPA who fought me about doing Roth conversions for his clients. And then I shared some information with him, a couple of the books, and we talked a little bit. I think I sent him the Power of Zero book and maybe one of Ed Slott's books. And the following year, he actually suggested about $100,000 over what we had suggested for conversions for the client. Now, there are some reasons we pulled that back, but that's the kind of turnaround I want to see out there, because the more people that are educated or who are educated about these issues, the better. And just because your attorney is a licensed attorney or a CPA is a CPA, he or she may not specialize in this area. So it's important that everyone on that team is working together, because listen, I don't go to these other professionals and say, you're wrong. I say, well, you know, what if we look at it this way, or did you look at this part of the code? Because I'm an expert certainly in certain areas, but if an attorney comes to me and says we should or should not do a trust for these reasons, you know, that I'm gonna rely on their expertise. I'm certainly going to lend my advice if it's appropriate, but with the overall scheme of things as a planner. But I've certainly had attorneys and CPAs who have said, well, if you look at it this way, or look at this part of the rule, or this is why this has to be, you know, we all have to work together and continue to grow. So I hope that all makes sense. I just wanted to point out a couple of those things to pay attention to. All right, so let's talk about the Ed Slott updates. I'm really going to try to keep this down as far as time. I want to switch to financial planning typically by 10:30, but first I'm going to read you a regular Slott report update. I think both of these are good bits of information. So let me just jump into it. So these Slott reports these are both questions that come in from they can either be financial advisors or just the public asking questions. And these two letters are answered by Andy Ives, who's a really good analyst they're all great. All the Ed Slott analysts are great. I really enjoy the time hearing them. I can't wait to see them again. Hopefully in the spring of next year. I think we'll be in St. Louis, but let me jump into it. The first question is, this fellow Drew writes, my situation is as follows. I'm 56 years old and I have an IRA, which I've been taking 72T payments from since 2008. So this is a little obscure. 72T is a way to take funds out of an IRA before you're age 59 and a half, and it has to be done over X number of years. I believe it's 5 years or until you turn 59 and a half, whichever is greater, and they have to be equal payments. So it's basically if you just need to draw or you want to draw over time. I recently received a finding of disability from the SSA, which has been assigned an onset date of September 2020. Back pay will only be for February, April 2021, so nothing affects prior tax years. Can I stop my 72T? Another thing is when you do set up a 72T, 5 years to 59 and a half, whichever is greater, you can't stop it. It's got to continue to pay. That's the deal of the IRS. That's the rule from the IRS. So you still have to pay tax, but you don't pay that 10% penalty. So Andy writes, Drew, yes, the 72 payment schedule can be stopped due to a legitimate long-term disability. However, the definition of disability is strict, must qualify under IRS guidelines spelled out by the Internal Revenue Code. Then he gives a section, which is, again, what I love about the Slott group, because they not only give great information, but they refer to the tax code section. The IRA owner must fully fit the definition of disabled. For example, being retired on disability may not necessarily meet the requirements. So a little obscure, but a good bit of information. This one really hits home for a lot of folks. So this person wrote, hello, IRA gurus. I have a straightforward IRA RMD question, hardly ever. Is that the case? Straightforward IRA RMD question, but have not been able to find a written answer that is exactly on point. And that tells you right there, it's probably not straightforward. I am hoping you can help. I inherited both a traditional and a Roth IRA from my sister several years ago. I am the only beneficiary. Do I have to take RMDs, required minimum distributions, from each, or can I lump the total balances as of December 31st and withdraw only from the traditional IRA? Interesting question. So obviously she inherited this some time ago. Several years ago, she said, so she falls under the old rules. She's a non-spouse beneficiary, so she can do the stretch IRA. So she has to take requirement distributions every year. Now she can take the entire thing at any time. She'll pay tax, but no penalty, regardless of her age. But she can spread it out over time. So she's asking, well, I have to take them from my traditional. I have to take them from my Roth. Can I combine the two? Let's see what Andy says. In this case, each RMD, required minimum distribution, must be taken from the applicable inherited account. Only RMDs from the same type of IRA, inherited IRA, and from the same decedent can be aggregated. So if you had, for some reason, two inherited IRAs that you inherited from, your mother, brother, whomever, and they were both, you were the beneficiary, and they're from the same person, those you could combine. Because it's, if you had two, you inherited one from your father, one from your mother, you could not combine those. And in this case, Roth IRA, traditional IRA. Even though both of these inherited IRAs came from your sister, one is a traditional IRA and one is a Roth. Since they're different types of IRA, despite coming from the same decedent, the RMDs cannot be aggregated. So Andy just saved Sally, this woman is Sally, just saved Sally potentially a bunch of money, because if she aggregated those, first of all, it would probably be considered a full distribution. She'd pay tax on the traditional IRA all in 1 year. Operationally, I don't know how you would go and aggregate them. You can't take a inherited IRA and convert it to a Roth. So somehow the Roth would have to go in the traditional. I don't even know how that would be done. But anyway, if you tried to aggregate it, it would probably be considered a full distribution. She would pay tax. The alternative is she may, even if the Roth may have somehow, and custodians make mistakes, end up in a traditional IRA. Well, she's paying tax on something she doesn't have to pay tax. You have to take RMDs from an inherited Roth IRA under the old rules, not if you inherit it after last year. But now we live under the 10-year rule, right? You have to vacate, distribute the entire thing under the 10-year rule. But if you inherited before that, you had to take RMDs, required minimum distributions, out of a Roth. But of course, there's no tax on that. So you don't want to aggregate a Roth tax-free to a traditional. Goodness gracious, we do so much work to go the other way. So one of the favorite parts of the Slott training I do are the annual cases and rulings. So this is when they tell us what's happened out there. What are people going to the IRS for to ask for leniency, or what are they getting penalized from the IRS? What are the case laws out there? So in this case, and I just love these. So in this case, the headline here is IRA trustees wipe out an inherited IRA, their own inherited IRA. A lifetime of accumulation and growth goes up in smoke when beneficiaries don't know the IRA trust tax rules. This was from a private letter ruling. So a private letter ruling is when someone applies to the IRS to say, I'm looking for an exception to this rule. Then there's some research done in the IRS rules one way or the other. Now, what you always have to remember about PLRs, they're called private letter ruling, is that even if the person who requests it is granted some relief let's just call it granted relief or have a finding in their favor, it only applies to that person. You see sometimes, well, so-and-so has a PLR for this, which means everybody else can do it. That's not the case. So if I get a PLR that says I don't have to pay my taxes for 2021, then it doesn't apply to you. So that's not going to happen, by the way. And PLRs are expensive. I think the minimum is about $5,000 to $10,000, probably closer to $10,000 range now. But so the headline, or the continued headline, is imagine spending a lifetime building a retirement account only to have beneficiaries lose it in one fell swoop. They mishandled the account, triggering tax on the entire inherited IRA. Now, when I read this, it's reminiscent, and I'll go back to the team. I had an attorney who called me one time, and she wanted help with her fiduciary responsibility and the executor's fiduciary responsibility in managing an estate. And it was all in an IRA, and the attorney's talking to me on the phone, and this attorney said to me, don't worry. I talked to Fidelity. We already moved the funds into an estate account. And I said, I thought you said it was an IRA. And she said, I did. And she said, but I was talking to Fidelity and they suggested I move it to an estate account for all these reasons. Well, this is several years ago, 4 or 5 years ago. And we could have done stretch IRAs for the beneficiaries of that IRA, that inherited IRA. But in this case, it was done. Once she moved it to an estate account, it was done. It was a full distribution. All tax was due in that year. So that was a lawyer. Sometimes attorneys make mistakes. And she was an estate attorney. This person was an estate attorney. So it happens. You got to be careful. So they talk about transfer of inherited IRA assets into a non-IRA account is taxable and cannot be reversed. I've never seen a reversal on this. So here are some key points. A non-spouse beneficiary cannot do a rollover. Only a spouse can do that. So if you inherit an IRA from your spouse, you've got a lot of different options. You can treat it as an inherited IRA. You can do a spousal rollover. You can roll it into your own IRA, treat it as your own. There's a lot of flexibility there. But a non-spouse, not so much. A trust is a non-spouse beneficiary. Once funds are withdrawn from an inherited IRA, they cannot be returned to an inherited IRA. Funds in non-IRAs cannot be transferred to an inherited IRA. A trust is a non-spouse, and non-spouse IRA beneficiaries cannot do 60-day rollovers. Once inherited IRA, sometimes that's an answer. If you make a mistake, well, wait a minute. If, for example, if a spouse took a withdrawal out of an IRA and didn't intend to, because the spouse's flexibility is greater, he or she may be able to do a 60-day rollover. So realize quickly I made a mistake. There hadn't been any other rollovers done in a year. She or he could put the money back into an IRA and no harm, no foul there. But non-spouse beneficiaries can't do that. Can't do a 60-day rollover. Even if the error is identified within 60 days of the original transaction, there's no fix and the distribution will be taxable. In this PLR, the beneficiaries of a trust-owned inherited IRA learned this lesson the hard way. Upon the death of her husband, a surviving spouse inherited his IRA and assumed ownership. She then named a trust as the beneficiary of the IRA. This is not uncommon. Many people name trusts as beneficiaries of IRAs, often because their children might be younger, or maybe they're concerned that they're going to spend through the money quickly. That's becoming less common now, but it's still out there. After she died, after the surviving spouse died, the IRA assets were moved into a trust-owned inherited IRA, of which the children, as trustees, had total control. That's a little strange that the children, the beneficiaries of the trust, would also be the trustees, but I'm not going to comment on that. Naming a trust as the IRA beneficiary is often done when there are large IRA balances at stake, and the IRA owner wants to create some level of post-death control. I just talked about that. The children in this case wanted to trade stocks within the inherited IRA, but were informed by the custodian that the existing account could not accommodate stock trades. So I don't know who the custodian was, but wherever the funds were held, they couldn't trade stocks. And these kids, they inherited, now I don't know how, I see kids, I'm sure they were adult children. The children wanted to trade stocks within the inherited IRA, they couldn't. So the children decided to transfer substantially all, in italics and quotes, this is important, of the inherited IRA assets to a non-qualified, that is a non-IRA brokerage account owned by the trust. So they said they opened up an account at another custodian. They named it in the name of the trust, appropriately so, but they transferred it into a non-IRA, what we call non-qualified, or what's referred to as non-qualified, non-IRA brokerage account. So that's a distribution, right? It goes from an inherited IRA to a non-IRA. It's crossed that line. It's no good. This was a distribution of substantially all the inherited IRA assets, exclamation point. This was a fatal error. The inherited IRA becomes fully taxable. Let's see. Then they go on the right, or Ed goes on the right, but these beneficiaries tried anyway with a desperation Hail Mary attempt, which ended up costing them even more money. Several months later, the error was identified and a PLR submitted. The PLR, private letter ruling, requested that the trust not have to pay taxes on the distribution and the children be allowed to reverse the transaction by moving the assets back into the trust. So this is what they asked the IRS. Listen, we made a mistake. Can you just let us put it back in the inherited IRA? The IRS ruling, based on the tax code rules, the decision by the IRS was easy. The request to relieve the trust of taxes and to repatriate the dollars back to an IRA, an inherited IRA, were both denied. So they wanted relief on the taxes, the trust of the or the taxes of the trust, and to repatriate, put the dollars back into the inherited IRA, and the IRS said no go. So here's an excerpt from the PLR. Once the assets, so this is what the IRS wrote, once the assets have been distributed from an inherited IRA, there is no permitted method of transferring them back into an IRA. In this case, the assets of IRA X were transferred into a non-IRA account. Accordingly, the assets may not now be transferred to an IRA account. So, you know, that is really important. And these things happen often, all the time, I'll say. We get notification of these kind of cases all the time. It actually gets worse here because I talked about the fact that the beneficiary was a trust. Well, trust tax rates are generally much greater than an individual's tax rate. So while they may, we'll look at it in a second, but while they may follow the state, the same marginal tax rates, not exactly, but you could see them line up. Then, but what happens is income that's created inside of a trust gets taxed at higher rates much quicker. So because all that income happened in a trust, they were taxed at a very, very high rate when it was distributed out. So how could it have been done? Well, ideally, the mother who inherited the original IRA would have named the beneficiaries individually. Then he or she, the named children, could have handled their own inherited IRAs as they would have liked to, and it wouldn't have affected everybody. And even if one of them made a fatal decision to move it to a non-IRA brokerage account, then it probably wouldn't have cost as much in tax. But if someone would have just advised them that, hey, you can trade, you know, I don't know of any platform that wouldn't allow them to trade stocks if they really wanted to do that, unless maybe the advisor that was handling the account just said, I don't do that. So maybe there's a disconnect there. I don't know. But this is a really, really good example. I have a lot of them. I'm not going to go over them all today. But I'm sitting here looking at my notes, and I've got, I think, 3 pages of notes from just this section last week. I do see a question. Let me see a question or a comment. Let's see. So Gerard, can a distribution from a non-spouse IRA be used to start a new Roth account as a contribution of $7,000? Well, sure. You'd have to meet all the other parameters. So you have to have an earned income. So distributions from IRAs, pensions, things like that don't count. So you'd have to have earned income, and you'd have to be below the thresholds. Okay. Let me close questions. All right, so now I'm going to switch to my whiteboard, and we're going to talk for the rest of our time here about capital gains. All right, you should see a whiteboard in front of you, and it should read financial planning topic, year-end planning, capital gains. If you can see that, please raise your hand. Excellent. Thank you, everyone. All right, so you're going to see me look down because I'm going to be writing on this board. Okay, so let me just jump back to what we were just talking about. So I'm going to focus on trust tax rates. So you see here what I'm circling, 2021, I can make this larger. 2021 trust tax rates. So again, you can find this table right on my website under the Slott corner. You can download it, and you'll be able to have access to this. We'll get these tables updated as soon as possible. There's another one for the Secure Act, I think it was, that is not on the website that I want to get uploaded there as soon as possible because it's a really good reference. But you'll see here, while the marginal tax rates might look similar, 10%, 24%, we missed all these in there, didn't we? 35 and 37. While they may seem similar to what we see here, so we missed 32, we missed 22, and we missed 12. If you move funds into a trust and you create income in that trust, whether it's a beneficiary of an IRA or whether it's just an account that's, and I'm talking about an irrevocable trust here. I'm not talking about a revocable trust. That's taxed differently. So irrevocable trust. But if you create income in that trust, you're going to be taxed at much higher levels. So to hit the 37% bracket here, or income over 37%, you've got to be over, for a married couple, $628,000 under this code, $523,000 as a single filer. But a trust hits that level at just $13,000. So imagine that was the trust I just talked about was a multi-million-dollar trust. You'll see that almost all of it is going to be taxed at a much, much higher level, where we could have gone through all these phases before we hit that, all those gates kind of before we hit that, if they were directly inherited. All right, so now let's jump to capital gains. So this is another topic that is often part of confusion when it comes to Roth conversion. So year-end, sorry, we got a lot going on here. Year-end planning often consists of a conversation around income for the year. So I talked about this a few weeks ago, but income, of course, any earnings you have, pension, Social Security, rentals, distributions from any of your accounts, your retirement accounts. So your 401k, your IRA, 403b, any of those that are going to create taxable distribution. Roth distributions, as long as they're qualified distributions, you're 59 and a half, you've crossed that 5-year period. That's not what I'm concerned about, because they're not taxable. I'm talking about taxable distributions. And then, of course, we have capital gains. So we have, how did this get back there? I moved that table. Let me just, all right, well, I'm going to go down here. So we have, when we're talking about capital gains, now there's also interest and dividends, but today we're going to talk about capital gains. We have long-term and we have short-term. So let's talk about short-term for a minute. So this is typically less than 1 year. So you buy, it's really hard for me to just name a stock, because then somebody says, well, is that a recommendation? No. So you'll buy XYZ stock. So that is a less than symbol, not 7. You buy XYZ stock, and you bought that 10, 25, 2020, and you bought it for $100 a share. It's had a great year, and it's grown to $200 a share. Well, if you sell that stock on 10/20, 2021, you have $100 worth of gains, correct, per share? That answer is yes. So you've doubled your money. You have $100 per share worth of gains. So if you sell that on the 20th, well, that is less than 1 year, and that would be considered short-term capital gains in most cases. So unless it was net unrealized appreciation stock or something like that. So now what happens to this gain? Let's just say overall, let's say you have 10 shares. So times $100 is, of course, $1,000. So you've got $1,000 worth of short-term gains. Remember, we're talking about short-term. So what happens is the short-term gains are treated as ordinary income. So they fall into these marginal tax rates. So you've heard me explain this a million times. If you're married filing jointly, your first $19,900 is taxed at 10%, $19,901 to $81,000 is taxed at 12%, $81,172 is taxed at 22%, and we get this blended rate. And you might be at, say, depending on how much you have in each gate. I'm going to start calling them gates. I like that. You kind of hit these gates. You might be in a 15%, or I'm just throwing it out there, effective tax rate. Well, this plus one, let's say your earnings were $81,000. Your taxable earnings for the year from your job, every other thing, was $81,051. Well, now you add $1,000 onto that for your short-term capital gains, right? That's how it's taxed as ordinary income. All right, so we understand that. That's pretty easy. And that, of course, would affect. So if you had big short-term gains, let's say you had, how many shares do we have here? Let's say you had 1,000 shares of this stuff. So if you had 1,000 shares times 100, well, that's $100,000, right? That you have in gains. If you did it, if you sell it on 10, 20, 20, 21, because you just can't wait, you know something about it, somebody told you something about it, you get a tip, whatever, you sell it, well, now you have $100,000 worth of capital gains, and that could shake your Roth conversion strategy, right? Because let's just say if you wanted to stay below, and this is where many people are, if you wanted to stay below the 24% bracket or not go into the 32 too much, and then suddenly you've got $100,000 worth of capital gains, well, it's going to affect how much we can convert. We may have to reduce that conversion amount by $100,000. All right, so I hope everybody understands that. No questions. Now, that's short-term gains. Let's talk about long-term gains. Let's take this same situation and increase it by 6 days. So now you sell this same position 10/26/2021. Well, it's greater than 1 year. I would definitely, if I was doing this, I would just check the count. I always check the count. I know that 10/25 and 10/26 is 1 year, but I always just make sure that I'm not, that something isn't off, but I don't like to run that close. And I'll tell you why, because the difference is pretty great. So let's look at the capital gains rate. The capital gains, if you are at $0 to $80,000 in modified adjusted gross income, then your capital gains rate is 0. So if you have a year where you want to start selling off positions and your income is low, then you could get out of there at 0. For single filers, that's $40,000. We jump up to 15%, and I'm going to talk about this asterisk for a second, between $80,000 to $500,000 for married filing jointly, and this is a focus on a new tax code. Single goes to $40,000 to $445,000. So that's a big spread for 15%, and then of course over 501 or 445 or at 20% asterisk. So you'll see here, this is a really good point. The top rate is effectively 23.8% for those subject to the 3.8% Medicare surtax on net invested income. And that is for modified adjusted income over thresholds of $250,000 for joint filers and $200,000 for single filers. So if your modified adjusted income is greater than $250,000 and $200,000, you've got to add another 3.8% to the capital gains tax. So you'll see here that that it can be taxed differently. It can go all the way from 0 to 20%. So that could be advantageous compared to your effective tax rate. Or yes, but or it could be roughly the same. I do see that a lot where it's, we talk about capital gains rate, your effective tax rate is 15 to 18. Your income's high because of Roth conversions or just because your income's high and you're at 18% for capital gains. So it's kind of a wash, and that's okay. What you have to know is this, that while long-term gains, let me jump back up here. Sorry for moving around. I'm going to erase this. Long-term gains, as opposed to short-term gains, remember short-term flows into here. Long-term gains stays here. It all stays here. It's calculated differently. So I hear people say, I've heard accountants say this too, well, there's an extra $100,000 with the capital gains that's going to affect the long-term capital gains. That's going to affect the amount of Roth conversions they can do. Well, maybe, but here's the maybe. It affects the amount of Roth conversions that the client may want to do because that client still has to pay tax on those capital gains. It doesn't take you up into a different threshold, right? It doesn't, if you have $100,000 worth of long-term capital gains, it's not, and your income is 329, it's not like automatically now your income is 429,000. It's just that you have to pay tax on that. And that is a big difference that most people don't understand. Now, let me just pause on that for a moment and see if there's any questions, because that's confusing sometimes. Okay, but the difference in tax now, the amount of tax would certainly be more. Now that's where this gets real easy, because we use a software that shows the projected amount of tax. Because if you're looking at $100,000 in long-term capital gains, and let's just say you're at 15% for easy math of capital gains tax, and this is long-term, well, then you have to pay an additional $15,000 in tax. Well, let's just say that you're already paying $40,000 in tax from conversions. Well, while the $100,000 in long-term capital gains may not reduce the amount that we can technically do in Roth conversions based on the marginal tax rate, you might say, well, wait a minute. I was planning on $40,000. Now it's $15,000 more, and that's $55,000. I'm not budgeted for that. I don't want to pay that this year. Now you might say, let's reduce the conversion by X number of dollars to keep me at $40,000 in tax for the year. That's where it could be an effect. We're talking about the tax dollars and how much is coming out of your pocket, what you're willing to pay or what you can pay, not the marginal tax rate. So that's a confusion that I often see out there, and those two things have to be separate. I hope that makes sense. All right, so that's capital gains. You'll see here on the, there's also a really good chart on the website for tax planning for investment income. So if you think you're going to have a lot of capital gains this year, as your year-end planning, and you're doing some Roth conversions, which is going to add to your modified adjusted gross income for these purposes, or you get a big bonus. I know many people, it's been a good year for many people in the business world, so they're getting bonuses, and you want to go through and see how you're going to be affected. This is a really good chart that you can go over, and it highlights many of the things I just talked about. So that's it for today. It's 10:45. I look forward to seeing everyone who's going to be joining us on the in the class tonight. I look forward to seeing everybody on next Tuesday for the next webinar. And also, we, of course, have our special webinars that'll be coming up. I'm trying to squeeze one in for the end of November, but because of the holiday, I'm not sure if that's going to happen, but I'll let you know. Thanks, everybody. Have a great week. We'll see you soon. Take care.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.